95% of traders fail their first prop firm evaluation, and only 10% actually get funded. But what if I told you that there was a tool that I built so that you never fall into that 95% category? I don't know how long this video is going to be up for because this is something that prop firms do not want you to know. And as always, anything that I share with you in today's video will be available in the description below for free. Starting off, it's very important to distinguish who prop firm trading is for and who it isn't for. So what I've done is create this little illustration to help get that point across. So who is prop firm trading for? It's for people who have a proven strategy, a strategy that they've possibly back tested or forward tested. They know very well all of the rules that go into that strategy when it comes to entering, exit, management. All of those things are very important for them to know. Next is for people who I say would have a capital constraint. A lot of people who have a good strategy, they might feel a bit overwhelmed with the fact that it's going to take them a very, very long time to scale up that account and compound it. Then they can go to prop firms to help shorten that time to get to their desired capital size. I'd also say that prop firm trading is for people who have discipline, but also a lack of discipline. And let me explain this. Prop firms have these relatively strict risk management rules compared to when you're just trading your own account where there aren't any rules. There's no rules to your daily max drawdown or to your weekly max drawdown. You just trade until you possibly blow up your account, right? That's when you stop. But if you struggle to have the discipline, when it comes to position sizing or making sure that you don't oversize, then when you're put into this prop firm environment, you have no choice but to follow these rules. And all you lose is the initial money that you put in just to get this challenge account. Or if you're funded live, then it's whatever kind of cushion you've built. But whereas when you're trading your own account, your whole capital is at risk if you suddenly lose your discipline. Next, let's go into who it's not for. And this is very important. If you are a very, very beginner trader and you don't have any very specific strategy, which means you don't have any edge in the market, then you should not be trading prop firms. Your focus should simply be on, trading on demo or with very, very small size and trying to find a strategy that best suits your personality, right? Because not every strategy is for everyone. So your focus is just like finding a strategy, gathering the data on that strategy. And once you have the data, then you can start considering looking at prop firms. Next, if you are a sort of a very big swing trader or more investor, then prop firms are not for you. I am a swing trader. And the way that I kind of look at prop firms is if I have, a specific type of setup that's very high probability, then I might just look to take that setup on, a much larger prop firm account. That way I can continue to just grow and scale that account with that high probability setup where I can risk more than like 1% on that account and not have to worry about, reaching those sort of weekly or daily drawdown limits. But I kind of advise, for day traders, it's much better suited as, you're taking more frequent setups as opposed to like just taking months to do one challenge. The next type of person that I don't recommend prop trading for is, if you are a complete degenerate gambler. While I have seen, and I know that there are some stories of these people who got a prop firm account and scaled it to a ridiculous amount, but this is just the illusion that you see, especially on social media, right? What you won't see is how much money that they've spent on prop firm accounts or evaluations, right? You're just going to see that end result, because even if it's not prop firm trading and you're just trading your own account, if you have this gambler mentality, then most of these people in the end up blowing up or giving back all of their gains. So remember, if you are a gambler, then I would kind of just steer away and maybe focus on something else. At the end of the day, prop firms are there to scale your edge. They're not there to create it for you. Right here, you have an example of a 100K evaluation for a prop firm account. It's a standard one phase, 100K, 80-20 split. Your profit target's 8%, so that'd be 8,000. Max daily loss, 3%. So that's the maximum that you can lose on that day. And then your max drawdown is the maximum amount that you can lose on that account before it is terminated. And then this is just for a phase one. Now, the reason I'm showcasing this is because it ties very, very closely to the tool that I've built, which we'll get into right now. So this is my how many losses until I blow the fuck up tool. Very creative name, but it suits in very nicely. So what we have is kind of a sort of 5-part tool. Now, starting off, you have your account rules. Now, the purpose of this tool is that you can put, the existing data from your strategy, such as your win rate, your risk reward, and, eventually how much you're willing to risk per trade on those accounts. And you can input manually the type of challenge that you're looking to get into. So whether it's a $100,000 account, a 50K, 25K, 200K, right? No matter what the account is, and as well the specific profit targets, max daily loss, or max drawdown, and drawdown type, you can manually input those numbers with your current trading strategy data, and it will tell you how many losses that you are able to take in your strategy before your account blows the fuck up. So let's just input an example of the data. So let's say we have a 60% win rate. We are having a risk reward of 2R, and our risk per trade is, let's say, 2%. So what you'll notice is this graph right here is showing me, how many trades, or particularly how many losses I can take before my account becomes closed. So we see here that we have our equity curve. So this is just the losses. In the dotted lines, it's our daily loss limit. So we can see right here. So if we're risking 2% and we have a max daily of 5%, we're gonna be taking 2 losses. There's still 1% spare, but it's 2 losses, and then you're capped for the day. And the same thing the following day. And on the third day, then our account is closed. So one of the ways that you can decrease the likelihood of your account blowing up is by reducing the position size. And risk management is the name of the game when it comes to passing prop firm evaluations, right? The reason most people blow up their accounts is because they have no concept of risk management. And within risk management, you have multiple different areas. And one of those areas is your win rate. So quickly, we just have this graph here that kind of showcases why win rate isn't necessarily the most important metric when it comes to your trading. So if I have a 1-to-1 risk reward, then I need a 50% win rate to become break even. If I then start to target a 1-to-2 risk reward, I only need a 33% win rate to become break even. And then 1-to-3, I only need 25. And for a 1-to-5, I only need 17%. So what is more important is what you call your trade expectancy, right? It's to make sure that when you're winning more than your losses. So the higher your trade expectancy or the RR that you target, the lower your win rate can be. If you're enjoying the video so far and you're finding some value, then please don't forget to show your support by liking and subscribing. Now let's get into position size. So we can see here under the risk per trade, if we focus your eyes on the drop graph, what you'll notice is, the lower my risk per trade, even though my risk reward and win rate metric remains the same, you can see how many more losses that I can take before my account blows up. So even though my losses to daily limit, it becomes 10, the losses to account closed becomes 20. And as I continue to reduce my risk per trade, the higher those numbers will be until my account blows up. But proportionally, the longer it will take for you to pass that account. So it's really about kind of finding a sweet spot. And that's where knowing your strategy is very important. Because if you have a 60% win rate, if you're targeting, a 1-to-3 risk reward, then you can more comfortably, be risking maybe around 0.5 to 0.7 of your account. And what we'll notice is at the bottom here, you have your loss by loss. So this is much more of a kind of another visual representation of how many losses you can take before your account blows up. So we see here that, starting off, if I take 1 loss, my account balance becomes 99.3K. And the drawdown used is only 7% of whatever drawdown is on the account. So we can see that I can take 7 losses in a day before I hit my daily risk limit. And I can take an additional 5 losses before my account becomes terminated. And vice versa, we can also have a look at the getting paid aspect of this tool, where I can see that, okay, if I take 4 wins in a row at 3R with a 60% win rate, then it only takes me 4 trades to pass my account. And then we have our realistic trades to target. So the realistic trades to target looks at, your actual win rate and will factor in, the losses expected with that win rate. So you can see that more realistically, it is going to be 9. Because with trading, you never know when you're taking a trade. Let's say you have a 50% win rate. You never know if you're going to have, a loss, a win, a loss, a win, or if you're going to have multiple losses in a row or multiple wins in a row. You can't predict, the individual outcome of trades. But what you can predict is the overall outcome over a large enough sample size. And the way I kind of phrase it to people is think of it like a coin flip, right? It's either heads or tails. So you're thinking, okay, what's a 50-50? It's heads or tails. Well, it's always going to be either heads or tails, one after the other. It's not. There are times where you can just flip a coin, like it might be heads 6 times, 7 times. So you never know that. So the whole point is when you're kind of approaching these prop firm accounts where you have these risk management rules, is that you are risking a small amount, relative to what you might be assuming. I'm not going to risk 4% or 5% or like the full daily drawdown on one trade, because that increases the chances that I blow up. So the whole point is staying alive long enough, to get to that funded or to continue to grow your account. So by risking, smaller amounts on your trades, you have a better likelihood of passing these challenges. The next sort of topic I wanted to talk about is, your risk reward. So I spoke about what's the win rate needed to become break even, right? And you see like the larger your risk reward, the lower the win rate needed to become break even. But when it comes to risk reward, I want to talk about, whether you use a dynamic risk reward or a fixed risk reward. Now, personally, in my system, what I use is a dynamic one. Now, what this means is, for example, this is one of the old BTC ranges that I've traded. So with a dynamic take profit is like, I'm not looking at a fixed like 1 to 2R or 1 to 3R for every single trade. There's going to be some trades depending on all the confluence factors where I might be looking for, for example, a full rotation. So when we have a big deviation, I might be looking for that full rotation down into the range lows. But when a range is first created, I'm not looking for the full rotation from the range high to the range low. Instead, I'm thinking, okay, let me look for the mid-range, or let me try to identify key swing highs or key swing lows as liquidity targets. But when it comes to prop firm trading, if you have that same approach, it kind of becomes a lot more difficult to consistently scale that account. And let me show you why. Right here, we have 4 trade examples, that I've taken myself. If I'm following the rules that most people say for range trading, where it's like, okay, well, you short the range high and you're targeting the range low, you will notice how 3 out of 4 times price never reaches my target. On the second attempt, we nearly reach it. But if you have your methodology of like, I'm looking for the range low, that's where I'm looking to close out the trade, then you're just going to keep round tripping. And sure, on the last attempt, you're able to do it and you get, your 5 risk reward ratio. So why I kind of prefer this fixed risk reward approach when you're trading is because it can help you get and lock in these wins more consistently and help scale that account more. So let's just say I'm only going to target 1 to 3 risk reward. What you notice is I'm actually taking profit on every single one of these trades. So when I'm comparing it to the previous example, I'm round tripping on 3 trades and only locking in 5R on 1 trade, which was that final trade. But if I'm looking at a fixed risk reward, what you'll notice is every single one of these trades is locking in profit. Now, what you just have to accept is that there will be some trades that might have gone twice as far, and just accept it, because the fact is you're locking in gains and you're actually making more compared to just looking for the full range high to range low. Like I'm locking 3R on the first, 3R on the second, 3R on the third, and 3R on the fourth. So that makes 12R that I've locked in, even though price has gone down further on most of these, compared to only locking in 5R when I'm looking for the full range high to range low rotation. The final thing I want to cover in this video is the fact that you don't need to take every single trade out there, or even take a single trade every day. The whole point of trading, whether it's prop firm or not, is that if you want to consistently grow your account and scale it, you have to take the trades that are part of your system, that are part of your strategy. And me as a swing trader, there are multiple days and sometimes weeks where the market isn't moving and nothing lines up in terms of a trading opportunity. And even though I show up every day at the charts and I do my preparation, I have to accept that I might not take a trade that day. And if I start thinking of like, oh, I need to take a trade, I need to make money. If I have that sort of mentality where I'm focusing on the outcome of trades as opposed to the process, then I am more likely going to go into a spiral and blow up my account because I'm just going to keep taking trades and trades that are not part of my system. With that being said, if you want access to this custom risk management tool for prop firms where you can just input your own strategy data and you'll see how many trades you can take before your account blows up, then it will be available for free in the comments below. And as well, if you found value in the video, don't forget to hit that like and subscribe button to show your support, and I'll catch you in the next one.